Hello everybody, I'm John, this is JP Strategic Investments, and today I want to talk about the relationship between interest rates and stocks and how one can affect the other. So first of all, let's talk about why the two are even tied together in the first place. The main reason is because stocks and bonds, which are affected by interest rates, are generally a part of what's called a balanced portfolio. Most investment banks, hedge funds, and even the plans that most financial advisors put together for people like you and me contain a portion of bonds and a portion of stocks. And that ratio of stocks to bonds is dependent on how aggressive you want to be as an investor. For people who are closer to retirement or generally just want to be more conservative with their investments, those portfolios will tend to have a higher percentage of bonds and a lower percentage of stocks. If you want to be more aggressive, if you're a younger investor or just that's kind of your style of investing, you will probably tend to have more stocks in your portfolio than bonds. But what does this have to do with interest rates and stocks? Well, because the return that you get on a bond is dependent on the interest rate, that means that the higher the interest rate is, the more you get on your bond. And bonds are generally, as I said before, considered more of a safer investment. So if bond yields rise or interest rates rise, that means you can get more return on a theoretically very safe investment. Now, the reason that this affects stocks is because if you can get a higher return on what is considered a safer investment, then it does make sense to shift some of your money from stocks, which are considered riskier, into those bonds because you can get a higher return now at a lower risk to your portfolio. And that's why generally when interest rates rise, you get the shift of money moving from stocks to bonds. And how does that money have to move? Well, those investment banks, those hedge funds, or just people like you and me have to sell those stocks and buy bonds. Well, what does that do to stocks? Selling pressure pushes those stocks down. And that is why we generally have this relationship where if interest rates rise, then stocks will fall. Now, if interest rates fall, then the opposite is true, right? Because if the return that you can get on that bond, that safe investment, is now decreased, then it becomes less attractive to keep your money in there, especially if we're seeing any sort of high inflation. That will generally shift money from bonds into stocks. Buying pressure in stocks causes stocks to rise. So that is kind of the simplest way to explain this relationship between stocks and bonds. Obviously, there are other factors at play, but generally what you need to remember is that if interest rates rise, bonds become more attractive, so stocks fall. If interest rates fall, then bonds become less attractive and stocks rise. If you have any questions, let me know in the comments below. If you found this video helpful, don't forget to hit that like button. Other than that, I will see you guys next time and have a great day.